Planetrics brings deep modelling of both transition and physical climate risks. And at FTSE Russell, we bring benchmark construction, governance, distribution. And the goal is really to develop indices, transparent indices and analytics that help investors understand how these different climate pathways and scenarios can affect portfolios across asset classes.
Welcome to Index Ideas from FTSE Russell. I'm Paul Amery, your podcast host. In this podcast, we look into how FTSE Russell indices are built and why. We explore index ideas that can help you address real-world investment challenges. As a reminder to listeners, you can't invest in an index, and so the concepts that we explore in the podcast are not investment advice. Any reference to potential investment strategies is intended for informational and educational purposes only. In this final episode of Season 2 of FTSE Russell Index Ideas, we turn our attention to climate change and the energy transition, where global policy is increasingly uneven and volatile. I'm joined by two guests. Stephanie Maier is Head of Sustainable at FTSE Russell, and Thomas Bremner Bligaard is Managing Director and Co-founder of Planetrics. In May 2026, FTSE Russell and Planetrics announced they had signed a Memorandum of Understanding focused on the joint development of climate scenario-based indices and analytics. Stephanie and Thomas, welcome to Index Ideas.
Thank you.
Thank you.
Let me start with you, Thomas. Who are Planetrics?
Yeah, so that's a great question, Paul. So Planetrics, we are a sustainability analytics firm that specializes in helping financial institutions understand the impact of climate on their investments and on themselves. And why do we do that? We try to do it so they can limit risks, which we'll talk a little bit about later today, I'm sure, but also find opportunities from the low carbon transition. And we're a bit of a mix of people from different backgrounds, climate scientists, economists, and engineers.
Thank you, Thomas. Stephanie, how is FTSE Russell working with Planetrics?
Yeah, so FTSE Russell is working with Planetrics to help bring climate scenario analysis more directly into the index design. So as you've heard from Thomas, Planetrics brings deep modelling of both transition and physical climate risks. And at FTSE Russell, we bring benchmark construction, governance, distribution. And the goal is really to develop indices, transparent indices and analytics that help investors understand how these different climate pathways and scenarios can affect portfolios across asset classes.
Thank you. Thomas, why has the global consensus on climate fractured in the last couple of years, and what happens next?
Yeah, Paul, I think a lot of other things have happened in the world around climate that has changed our perspective since we were standing back in the heydays of Paris, where the Paris Agreement we committed to below 1.5 degrees. And there was sort of policy consensus that we were moving in one direction. One thing is geopolitical change. That means that different regions are moving at different pace on how much policy action they're doing on climate. The other thing I think we have learned, which is just as important and sometimes I think underappreciated, is that technology has moved very rapidly, but in certain domains. So we see very rapid technology evolution in things like batteries and solar PVs that are bringing down costs. So in those markets, we see faster action than we maybe thought when we were back in Paris. Whereas in other markets, hard to abate sectors and areas where we're very dependent on policy, like carbon pricing, that has not come in to the same degree. And that means that we are in a much more fractured world today than we thought we would maybe be in when we stood back in Paris.
Thank you, Thomas. Stephanie, where are we lagging as a world, and where are we ahead in our progress towards the 2050 net zero carbon emissions targets?
So I think we're certainly ahead in areas where we see the economics and the policy reinforcing each other. So areas like renewables, electric vehicles, batteries, so, parts of that clean technology investment, those opportunities linked to the low carbon transition. think, we're lagging where it's harder system change, decarbonizing heavy industry, where you need a lot more of that policy alignment and financing, all coming together. So I guess I describe the transition as real, but uneven, echoing that point that in different markets, it's taking different pathways. So I think that, the challenge and the perspective for investors is really, kind of where exactly is the transition happening, how fast, and what are the consequences for portfolios.
Thomas, could you elaborate a bit more on how existing climate scenarios hold up against the messier transition that we're all now facing?
Yeah. So I think maybe before I get into that, Paul, I think the starting point is to say that there's a lot of good work that has been done on climate scenario analysis by all sorts of different research groups, and GFS is one of them. And they are doing a very good job in trying to predict the future. But the future has just turned out to be more messy than the stylized worlds that they were describing. And some of those models were also designed to answer a slightly different question, which is what policies should we have to meet certain targets? And that means that if financial institutions consume those scenarios just naively, they get disappointed because we don't see a gradual uptake of renewable technologies. We see it more happening in waves. We don't see carbon policy being rolled out gradually and in a consistent framework across different domains. And we see some regions moving really fast. Like we know that there's a lot of decarbonization happening in China, happening at a probably even more rapid pace than some of those scenarios were capturing. So it's really linked to Stephanie's point around that we see some technologies accelerating transitions and some policies in certain regions accelerating transition. And that's what we're really hoping with this partnership with FTSE, that we can give investors access to some of those insights that we see in the real world.
Thank you, Thomas. Stephanie, FTSE Russell obviously talks a lot to asset owners, interrogates them via surveys and publishes the results. How are those asset owners currently integrating climate risks and the associated opportunities into their long-term asset allocation decisions? And what key challenges do you think they face?
Yeah, so we're seeing asset owners increasingly, I think with greater conviction, treating climate as an investment risk and return issue. So we see the implementation through, broader ESG integration and more specifically on climate. Using scenario analysis as a forward-looking way of understanding that risk and opportunities from within the portfolio. We're also seeing that from more thematic allocations, allocations to climate transition benchmarks, but also in things like stewardship as well. The challenge is partly, as Thomas referred to, the state of the markets as we have at the moment. We have differing regulation, different pace of change and transition in different markets. And importantly, how do you translate those signals so that, the policy, technology, what's happening into the investment implications, the impact today, but also over the longer term. And, that challenge is something that, continues to be something that we work with our clients on, and also where we think, transparent indices and analytics, building in this additional lens, kind of scenario risk lens is really helpful.
Thank you. Thomas, how do we get to pricing climate risk in dollars instead of scores within a model?
A really good question, Paul. So we take a four-step approach. So first of all, you need to know what is changing in the world, because what we're talking about here from a climate perspective, both policy and technology and the physical environment will change independent from whatever we do. If we don't apply a lot of policy, temperatures will rise rapidly. If we apply a lot of policies, well, then taxation and so on will change. And that means our history is a bad predictor. So first we need to define what is happening in the future. So that's what we call a scenario. Then we need to translate that scenario into economic shocks. So what does an increase in temperature mean for things like wildfire damages? And then we need to understand, what does those wildfire damages affect, for example, a company's activity? So how much exposure does a company have in Spain, wildfire areas? And once we have those three, we can get the first idea about how might wildfire risk drive cost increases on the company side over time. And then we feed that into a financial model. And that financial framework is the same as we would as a normal investor. But it all starts from the recognition that the future will be different from the past. If the future is exactly like the past, then a lot of our existing tools could work. The problem is that the future is very different from the past.
And how can we integrate transition and physical risk into a combined view? Stephanie, let me start with you.
So, I mean, exactly as Thomas has outlined, you need to understand that, transition risk, policy, technology, market shifts and how they affect companies, but also the physical risks, how things like the heat, extreme heat, flooding, storms, water stress, how they affect kind of assets and supply chains. So looking at those together and having a combined view helps investors have that sort of fuller risk adjusted picture. So, not just how well a company is decarbonizing or how well they are positioned for that transition, but that interconnectedness with sort of resilience to the changing climate. And that's a dynamic picture, but one that, we think with our partnership now have a much better lens to offer our clients, asset owners and asset managers.
So, Thomas, what are your thoughts on how best to integrate transition and physical risk into a combined view?
So I think Stephanie hit the nail on the head, like in terms of describing that we would use the same mechanics as I outlined earlier. What I think is more important to highlight is that this is it. You need to have the two-sided risk approach because they are not additive risks. So to give you an example, if you're a real estate investor, you only think about insurance costs going up, but not the increased retrofit costs from reducing your carbon footprint, well, then you might underestimate the impacts. And if you did it in isolation one way or the other way, you might get to a wrong conclusion on the investment case. And therefore, we believe in that assessing both physical and transition risk in combination is key.
Thanks, Thomas. Stephanie, so why is it challenging for a benchmark to reflect how the climate transition is actually happening?
Well, I think what we've been talking about is how the transition is hard to predict itself. It's messy, it's non-linear. The beauty about benchmarks is that they're, very sort of clear, rules-based, repeatable methodologies, bringing together something that helps investors understand what those pathways look like and therefore how various strategies perform against them, as well as thinking about, okay, what does all of that climate insight around the transition physical risks tell us about what would make a good investable index, also incorporating things, diversification, turnover, tracking error considerations, all of those things, means that actually, there's a huge amount that's possible with that construct and that design. And that's what we're sort of looking forward to developing.
So, Stephanie, what indices are FTSE Russell and Planetrics working on together, and when can we expect to hear more?
So we're working closely together on a range of climate scenario-based indices and analytics, as we've outlined, sort of drawing on that climate transition and physical risk, modeling and insight. We're very much focused on essentially decision useful climate benchmarks, really helping investors position for a range of plausible transition and physical climate outcomes. So we will be sharing more later this year. So do watch this space.
Thank you very much. And any concluding thoughts? Let me start with you, Thomas.
Yeah. First of all, thanks for a great discussion today. I think one thing that is worth highlighting is that climate risks and climate impacts are not short-term thing. We're seeing very high temperatures at the moment in Western and Northern Europe. We have also seen high energy cost shocks this year. They are materializing on a horizon which is meaningful for investors. And that's why I'm so excited to work with FTSE on creating products that make this easier for investors to act on.
Thanks very much. And Stephanie, any thoughts from you?
Yeah, so I think we're getting, with scenario analysis, with modeling, with these insights, we're getting a much better picture of what the impacts are going to be from both the transition and physical climate related risks. Really excited to be thinking around how we continue to enhance, from an index perspective, those, that data, the scenarios, the tools, the insights that will really make a difference to investors.
Great. Thank you very much.
Thank you.
Thank you.
That's it for this episode of Index Ideas. If you've enjoyed the conversation, then please follow us and give us a rating or review on your podcast app of choice. If you'd like to get in touch with the show, you can do so via the email address fmt@lseg.com. But for now, from me, Paul Amery, goodbye.